A big move in the outlook for the first quarter, which, by the way, we get next week. Our rapid update up 0.4% for the first quarter to 2.1%. So what was thought to be a really weak quarter, we've had this number, which is the median of tracking forecasts on the street, as low as 1%. And now it's up above 2 for the first time. So what was thought to be weak is maybe not as weak as people originally thought. Take a look at the second quarter as well. Still, this is the current quarter we're in, still running the forecast for that, running 2.7%. And then taking a look at some of the forecasts we have out there, you can see that at the high end of the range, we have the Atlanta Fed at 2.4, along with Stephen Stanley from Amherst Pierpont. In the middle there is Bank of America and Action. And then we have at the low end of the range, Oxford at 1.7. But these guys are 0.7, 0.6% increases in their outlook for the first quarter.
Wow. Because
of that narrower than expected trade deficit that came in below 50 billion. So, market panicked in December over a possible recession, but it's not looking likely this in the most recently completed quarter, Scott, or the second quarter right now.
So interesting, because over the last several years, Steve, in the midst of this longest running bull market ever, you have periodically had these massive growth scares, and the market's gotten, ridiculously upset about it. And maybe we're witnessing that, or we have witnessed it yet again now.
I wish one of those guys there who do those program tradings on your desk there would run the playing the second quarter rebound story, because it has been a pretty reliable thing. We've had this weaker than expected first quarter, and it's come back in the second quarter. I will say this, Scott, some work that's been done by Mike England, Action Economics, tells us that the weakness of the first quarter that ends up being unexpected happens in March. We don't have that March data. So I'd say watch very carefully tomorrow morning's retail sales report, next week's durable and the home sales data to see if that comes in weaker than expected. If that comes in on target, we maintain these 2% numbers, I'd feel pretty good about the current level of growth right now.
Yeah, so we don't need to cut rates. Right? We don't need these emergency measures, do we, Steve?
Maybe the rate hike made sense. I don't know. If you're going to do 2 and then you're going to do 2.7, you are going to be running above trend. And let's not forget that as much as the politicians might want to think trend is 3%, the economists think it's closer to 2. So when we do 2, they think the economy is running at capacity.
Yeah. Interesting stuff. Steve, thanks for jumping on with that.
Pleasure, Scott.
All right, our Steve Liesman down at the Fed. What do you want to make of that?
Yeah, I mean, I think it's basically indicative of what we've seen in the market. The market has been pricing in better growth, and that's why we've seen the stock market rebound so far this year. We've seen a similar but maybe lagged thing happening in China. And I've actually been watching the China data very closely. We got total social finance last week. We got a slew of data this morning that came out much better than expected from China. And that's very encouraging, not only for the global story, but for those areas of the non-U.S. developed market like Europe and Japan that are very much tied to the Chinese trade and export story. So we are expecting that to continue to be a tide that lifts all boats. I would say there's a number of risks in Japan and Europe that keep us a little bit more cautious for now, but we're encouraged by what we're seeing out of China.